The Senate has approved a bill that eases banking rules. It now heads to the House. But Financial Services Chair Jeb Hensarling pledges he will not approve the bill in its current form. For more on Dodd-Frank and that rollback, let's bring in Jack Lew, former Treasury Secretary in the Obama administration, who also served as White House Chief of Staff and OMB Director. Mr. Secretary, it's good to see you. We were, okay, let's do, since I introed you with the Dodd-Frank stuff, we'll do that. Then let's go to tariffs after that. And then let's even go to GDP and tax reform and whether you think there's some cause and effect there and whether some of the bonuses and some of the positive things that happen, whether you really attribute it to that. So, but let's start with Dodd-Frank. This is a right move on Bear Stearns on the anniversary?
Look, I think as we start this season of 10-year anniversaries, we ought to remember that 10 years ago we didn't see what was coming, and we passed financial reform to get visibility into a system. And there was always concern that small banks shouldn't be overly burdened. But the question is, what do you need to know in order to see a crisis before it's beyond the ability to address it? You know, I'm concerned that defining the threshold at $250 billion is too large. You know, major sources of failure, countrywide was less than 250. IndyMac was less than 250. The idea was never that you were systemic if you were 50. The idea was if you were larger than 50, regulators needed to know what was going on so they wouldn't be surprised. I hope that this doesn't leave us exposed. In general, one of the things I'm worried about right now, we're late in the economic cycle. We know that at some point there's a speed bump on the horizon. We're taking our eye off the ball a little bit. You know, on leverage, we're saying banks can get more heavily leveraged. On consumer protection, we're saying let's roll back the CFPB. And now we're saying let's make it smaller, larger banks only that get extra scrutiny. I just hope we don't miss the next crisis. One of the lessons 10 years ago was you need to look ahead, you need to see what's coming, you need to react before it's beyond reach.
Do you have any semblance or indication in your mind of how another crisis would manifest itself within the financial system?
So I think one of the realities is you don't know in advance. Afterwards, it's crystal clear.
But is there any path that you see?
Look, I think that we're in a different world now than we were 10 years ago. There's much more influence of algorithmic trading. There's much more complex electronic platforms, not just for the automatic trading, but how quickly things move. I heard a little earlier you were talking about cybersecurity. We have a whole new level of threats that 10 years ago people weren't even fully cognizant of. I think that the challenge is always to keep your eye on, is there radar up so you can see what's coming at you? Not can you predict with certainty what it is. We used FSOC that way, the Financial Stability Oversight Council. We asked questions, where are the areas where risk could come? It wasn't that we said because we asked a question about Area X, that Area X was necessarily going to be the problem. But you have to keep looking where are things changing, what's happening. I hope that's going on. I'm not confident it is going on right now.
The problem that you've heard from so many of the small banks in particular is that this was just such onerous regulation. And for small banks that would have to hire multiple people just to try and keep up with the rules and regulations, it almost made it so that they couldn't exist as going concerns anymore. So, that was bipartisan support in the Senate.
Yeah, and I think
back that.
When I was still in office, the debate was, should you go from 50 to 100? I think the debate going from 50 to 100 kind of addresses that issue. Once you're over 100, there are very few banks between 100 and 250, very few. And they're large institutions. They're not in the category of they don't have the compliance capacity.
Fewer now than there were before because many of them got bought up because they couldn't afford to keep up with the regulations.
That was happening before the financial crisis, that there was consolidation and it continued. So I don't know if the cause and effect is real. You got to kind of break apart the different aspects of it. You take something like the Volcker rule applying to banks under $10 billion. No one could object strongly to that because banks under $10 billion aren't burdened by the Volcker rule now. So that's something of a kind of recognizing reality. Not having the ability to see what's going on in banks at $200 billion is a different issue, and I worry about that. It's an anxiety that late in the cycle, approaching the speed bump, and if I can jump to the third thing that Joe, that you wanted to talk about, the fiscal decisions. If we had a crisis right now, if we had whether it's a financial crisis or a business cycle recession, we don't have the fiscal capacity to respond.
Or monetary.
Or the monetary policy. Right. It's quite scary. I mean, when we were in the Great Recession after the financial crisis, if we had not put $1 trillion into the economy, we wouldn't have had the recovery that we had.
Do more QE, I guess.
If the Fed hadn't been able to lower rates and do QE,
right,
we wouldn't have come out of the recovery. And we now don't have a fiscal arsenal because we spent it on the tax cut and on the spending agreement. We've kind of spent the fiscal resources.
Secretary, Gary Cohn left because of the tariff issue. If President Obama had said, you know, Jack, I just can't stand seeing some of the inequities that people are taking advantage of us because we're big and they think that we're not going to notice and their tariffs are much higher. Develop something for me that you can live with. Would you have had to leave, or could you have come up with some? Is there some way to do this that you wouldn't just dismiss out of hand?
Look, I didn't agree with a lot of the things that Gary Cohn oversaw when he was at the NEC. I think that the way the tax bill was advocated was not factually accurate. It's going to lead to.
But what about tariffs? Is there any?
I agree with him on policy on tariffs.
You would have left. If President Obama asked you to do it, you would have.
Let me put my own words out there.
Okay.
I think the challenge on trade is nobody disagrees that there has to be fair trade. We cannot let ourselves be victimized by unfair practices. The question is, what can you do effectively to deal with it? I think that the tariff decision that the administration made is very ineffective, and it undermines U.S. leadership in the world. We built the international architecture. We have to be honorable in the way we do it, and that means base it on facts, base it on law, base it on principles we believe in. I think the national security argument that was put out is a very weak one. I think to say that it's China and then have most of the impact be on Canada is not credible in the world. To ignore the spillover effect that you're going to lose more jobs in autos than you gain in steel is just bad economics. Whether you stay or you leave, I can't imagine embracing what this administration has done from day one. I couldn't imagine being in it after, you know, some of the policy decisions, some of the moral decisions, like, you know, Charlottesville. So I can't imagine being in this administration. What I do know is that the process you run at the NEC is important. It is the way that a president knows whether the two sides are equal or one side is actually a stronger argument. I don't know how well that was done before. If the message now is, I don't want to hear dissenting views, I don't want to hear the facts, that's kind of scary.
The eminent economist, I'm sure you've heard of him, Steve Liesman, has now, of CNBC, has now gone to 3% for the year. I guess you're going to tell me that the Obama administration cultivated the soil to the extent that this was going to happen anyway.
What year of the recovery in?
Don't you wish you had cut corporate taxes or had done something like that?
We're not in the first year of recovery. We're late in the cycle. It's potentially going to be the longest recovery, which means that most of it was in the Obama years. So let's just remember this. We inherited an economy that was going through the floor and it put together a recovery that
but you would have I know you say this every time you come in, but wouldn't you have liked a 1 year? Wouldn't you have liked 3% for you? We did it. Every other president got 1 year of 3%. Now it looks like it's going to happen. Don't you regret not cutting corporate taxes to get here?
I actually don't believe that the potential GDP has changed. I think in the short run, what this tax bill did is it threw oil on the fire. You'll see a little flash, but I think we're going to pay for that and pay for it quickly. I think you're going to see pressure on the Fed that is going to force earlier and more moves. It raises the risk of miscalculation because you've got this confusing set of signals. And I think interest rates are going to take away from the economy the kind of short spurt of growth that comes from throwing $1 trillion onto an economy in full employment. This is a dangerous experiment. We have never put $1 trillion of stimulus into an economy at full employment.
You saw the participation rate. How weren't you? Didn't you say, "Wow, that's great"?
It's
going
hard.
up. But it was at a low when we came in. So and not just old people, 25 to 54. So now you saw how great that news was. So maybe we're not at full employment. Maybe we can bring back some of those people and get above 63%.
I hope that we bring more and more people people back into
then
the
wages
economy.
start coming.
But let's remember that the labor force participation rate is going down for a number of reasons. Part of it is, like all of us at this table, we're not younger, we're
I'm
older.
talking 25 to 54.
More people are leaving the workforce.
A lot of people
because
25 to
age, demographics.
54 were
We are seeing more
discouraged, disenfranchised, and they're coming back.
Let's remember that in 2008, 2009, young people graduating from school couldn't find a job because the economy was in the tank.
Right.
So we had a catch-up period to get people back into their first job. I think we delivered an economy that was moving in the very strong direction. I don't think that we're going to see 3% growth as the new norm. I really do not believe. I don't know any economic forecasts that are showing that. I haven't seen Steve Liesman's forecast, but
Right.
I respect Steve. I'm happy to look at it.
I was joking. Okay, but it was 10 years since Bear Stearns, so you know how quickly time passes. Well, we're going to test whether we can do 3%. So there may come a time where you're in here, and it may even be more difficult to poo-poo all this, because it actually happens.
The basic argument that this was the tax cut, the corporate tax cut, was going to create jobs was that the money was going to go into wages. Morgan Stanley did some analysis that I heard on your greater network described yesterday morning. That 70% of it is going into stock buybacks.
Some will go to buybacks, some will go to wages, but it's going somewhere. At least it's coming back.
70% into buybacks and mergers, 13% into wages. That is not going to lead to the explosion of
unless demand picks up, then it goes into wages. You don't just hire people if there's no demand. It's a chicken egg thing.
And the thing that we need in this economy, not just in the United States but globally, is more demand.
Right.
I don't
this
think.
might help.
I don't think that tax.
Don't hope that it doesn't happen just so that you're right.
I root for success.
Okay.
I always root for success.
Okay. Good. I know you do.
But I also think the facts and the analysis. The argument that this tax bill paid for itself is just not true.
No, I know. Did you go back to your old signature, or did you keep the new one?
We've talked about this before. I've had trouble with my handwriting for a long time.
Did you go back to your old one? I liked your old one.
My handwriting has a
different
life
question.
of its own.
We got to hear the music.
I know, but when you're at a store and somebody gives you money back, you look to see whether it's your signature, Paulson's signature, Geithner's signature.
It's hard not to notice.
Nice to see you, sir.
Great to see you.
Thank you very much.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.